Hello and welcome everyone to another weekly market commentary from StashAway. Freddy, our Chief Investment Officer, is with us as always. Freddy, how are you?
Good morning, Philip. And lots has happened, lots of reversal. I'm sure we have a lot of questions today.
Yes, we do, right? Obviously, since last week, we've seen also, Bitcoin reach all-time highs. It's pulling back a little bit again, early start of this week. So maybe a lot of people got spooked there a little bit after, everyone was speaking about it again, quite highly. That's one thing, but also we've heard for the first time this month, obviously from the Federal Reserve, right? Just want you to give a little bit of a quick recap of what's said and how did that impact the markets so far.
Well, the Federal Reserve didn't really impact the market because they sort of the key thing in the testimony was they're going to keep their strategy until the economic outlook truly improves. And as you knew, the Fed has moved from a spot targeting an inflation to something based on an average inflation. And, that means they also didn't clarify what the window is for measuring an average inflation. So, which means that they have a lot of leeway to let inflation run higher than before, bringing an average up before they do something. So, I know there's a lot of inflation talk in the market or bubble talk in the market, but the Fed seems to be not so concerned and seems to be maintaining that monetary stimulus, maintaining the support based on where the real economy is, not based on where we think the market is. So I think that's reassuring to investors last night.
Absolutely reassuring on that front. You already kind of mentioned it, but obviously inflation concerns are starting to creep up, right? There has been obviously the last 2 weeks in the US with the winter storm, right? We had COVID, we had supply chain disruptions all last year. Where is that leading to? And are those inflation concerns warranted when you think about those?
Yes, before we all go ahead and blame the central bank for inflation and not thank them for saving the markets last year, I would say that you got to disentangle some of the inflation we are seeing now from what monetary printing is bringing. Number one, COVID-19 situation itself has led to some supply disruptions in many different places. We've seen that with in emerging markets where they are also agriculture exporters. So the OECD agriculture price indices has actually gone up quite a bit. So that's one of the trigger for why people were concerned, but that's not related to money printing. It's really transitory in nature because it goes away when we reopen the economies again, right? And we have great vaccine progress now. So there are a lot of transitory factors like that. The prices of metals were the same. You find prices of watches, luxury watches, gone up because of metal prices. But again, that's transitory, right? And once we reopen up, it goes away. So in a way, we're not really there, but people are just getting a little bit uneasy about the anecdotal evidences in their lives.
With that being said, Freddie, let's get to the questions. We have two really good ones that we wanted to pick out this week, right? That one is going into that direction of the inflation, but start with the first one. It was WNGKAI 91, probably wrong, but that's the person asking us a question. And he's saying, thank you for explaining the function of gold in all the previous episodes. Just curious, what will it take for ERAA, economic regime asset allocation for the people who don't know, is our investment model, to reduce gold exposure in the future? Specifically, what are some key indicators, economic ones, that might contribute to that, Freddie?
Thank you, Winkai91, for the very interesting question. So, to take it away is basically the reversal of everything we see, which means that, we added gold because of unprecedented monetary stimulus. That's why we have more. That means as the Fed start withdrawing, their stimulus is when you need to reduce gold. In principle, the indicator that would come true is when you look at the valuation of the US dollars, for example, against its economic fair value. As soon as the number looking cheap and start turning around, the US dollar re-strengthen, the gold exposure will have to be reduced. So it's actually a currency or a paper dilution, a paper money sort of angle. We are saying this, and also as the economic recovery strengthened and let's say momentum in the leading economic indices that we mention often, the conference board LEI, if that number start becoming going up a lot with a lot of momentum, it may also trigger a change in strategy where we go towards more growth and hence we move away from more protective assets, right? So that itself would also result in some reduction of the gold exposure. So it really depends on currencies, economic growth, their rate of change.
Absolutely. Great question, Wenkai91. Lots of people probably asking the same thing. Freddie, last question for the day from KP Low. He's saying, hey, Philipp and Freddie, given that the US Treasury yield for 10 years raised recently from 0.917% to 1.37% for the month Jan Feb, and the 30-year yield is now at 2.16%, which is near to the previous January 2020 prices, just before COVID. Is there a taper tantrum happening right now? And majorities are moving their money into bonds. Is that what you're seeing? Do you have a different point of view on that, Freddie?
The taper tantrum happened back in May 2013, where the 5-year government bond yields in the US went up by 1 full percentage point. If you use that as a benchmark or metric to measure the tantrum, today what we're seeing is about 36.6 basis points. So that's about 35%. Let's say a third of it that's happening today. So I think we're far from taper tantrum. But the difference is that this time the rise in longer term rates are actually more acute. Like for example, 10-year versus 5-year. 10 years gone up 84 basis point, right? During taper tantrum, it was twice that number. So we're halfway to the taper tantrum if you use 10-year, a third of the way if you use 5-year yields. It's really hard to say, but it's got a lot to do with the upcoming debate, the upcoming likelihood of the Biden White House being able to pass a $1.9 trillion fresh stimulus package. So it's sort of like those packages has to be financed, right? Somebody has to pay for it, and it's a future generations that's paying for it. It will be paid for. It will be through long-term debts. So that's why the long-term yields are rising more than the short-term yields, right? So in a way, it's really supply tantrum rather than a taper tantrum, because taper tantrum means the central bank, was at the time perceived to be withdrawing stimulus and scaring the markets. This time is actually a bond supply issue. Rather than the taper issue, if I'm clear.
Yes, no, you are clear, Freddie. Thanks for that explanation as well. And thank you for both of them for asking great questions. Keep them coming, as always, in the comment section below, or send us an email to support@stashaway.com. We also have another webinar coming up for our Malaysia audience. That is on investment basics. It's on Wednesday, March the 3rd. 6 to 7 p.m. Link is in the show notes below. Look out for any other events for Singapore as well as the Middle East region. We're always having new events coming up. So either I will be announcing them next week, or you can always go to our website as well. Freddie, thank you again for being here as always. Thank you all for watching, and we'll be back with you again next week. Until then, have a great week. Bye-bye. Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.